The world we're going to be in is a very different world than the world we were in. The world we were in started in 2008 and had to do with central banks printing money and stimulating, and that is reaching its limit. And that's why I think we're going to see a paradigm shift.
American billionaire Ray Dalio advises novice investors to maintain a diverse portfolio due to ongoing geopolitical and economic challenges. Bridgewater Associates founder Ray Dalio stated, "I'd like to have a diversification because what I don't know is going to be much greater than what I do know." Bridgewater Associates is one of the largest hedge funds in the world. How does Ray Dalio see the market going forward? Ray Dalio stated that he believes interest rate cuts by central banks worldwide by 2024 as stagflation strikes the international economy. The billionaire investor stated that he believes the U.S. market would be so badly damaged by the prolonged period of high inflation that rate cuts by the Federal Reserve will be necessary prior to the 2024 election. A combination of high inflation and slow growth is referred to as stagnation, given its correlation with rising unemployment, declining consumer spending, and decreasing earnings. It can be catastrophic for stock markets. Although it decreased a little to 8.3% in April, inflation is still near all-time highs. An additional factor fueling worries about stagflation is low growth. The OECD reduced its forecast by 1.5 percentage points, and the World Bank recently warned that a recession would be hard to avoid and decreased its global growth projection from 4.1% to 2.9%. Instead of focusing on fixed income investments, Dalio told the Financial Review that he's making inflation-hedged investments in commodities and pricing power stocks. While everyone was waiting for the Federal Reserve to announce its third jumbo interest rate hike, Ray Dalio, the founder of Bridgewater Associates, issued a cautionary note to those who were holding on to optimism that depreciated asset values would soon rise. According to Dalio, the Fed's attempt to control inflation will be unsuccessful unless it persists in rising interest rates significantly. Dalio believes that as a result of these and other causes, including the ongoing conflict in Ukraine, stocks and bonds will likely continue to decline and that the U.S. economy will likely enter a recession in 2023 or 2024. We're extremely close to having a 0% year right now. During the first Market Watch Best New Ideas in Money Festival, Dalio stated, "I think it's going to get worse in 2023 and 2024, which has implications for elections." She was speaking, and Market Watch editor-in-chief Mark DeCambre. Fed Chairman Jerome Powell has promised that the bank will use all available tools to fight inflation, even if doing so causes the economy and markets to collapse. However, Dalio thinks the Fed needs to increase benchmark interest rates to a range of 4% and 5% in order to achieve this. The Fed fund rate will rise above 3% for the first time since prior to the financial crisis, following its third 75 basis point interest rate hike. According to the CME's FedWatch tool, future traders believe that the Fed may hike the benchmark rate to as high as 4.5% by July, which would support trillions of dollars worth of assets. However, traders believe that there is only remote possibility that the rate will rise to 5% prior to another rate-cutting move by the Fed. How does Dalio view the impact of high interest rate on investments? After reaching its greatest point in over 40 years during the summer, inflation in the United States has somewhat decreased. However, when components of core inflation such as housing costs proved more tenacious last month than economists had predicted, a report on consumer price pressure in August sent financial markets into a tailspin a few days back. However, the prolonged energy crisis in Europe has caused prices for everything from consumer products to heat to rise even more sharply. Higher interest rates are a death sentence to real assets like the property market as well as financial assets, as Dalio demonstrated with some of the most fundamental ideas in corporate finance. Investors need to adjust the discount rate they use to calculate the present value of future cash flows or investment payments associated with a particular stock or bond and interest rate rises. Investors usually make up for this levy on these function revenue streams, inflation, and higher interest rates, by lowering the valuation. When investing, a lump sum payment is made for future cash flows. The present value of the investment is then calculated using a discount rate to determine its value, and for that reason, all boats rise and fall together, according to Dalio. All asset prices rise when interest rates are lowered to zero or nearly zero, Dalio continued. And the opposite happens when you go the opposite direction. Although Dalio stated that he anticipates further losses in stocks, he specifically mentioned the bond market as a source of concern. According to Dalio, the issue is that the Fed is no longer monetizing the federal government debt. The rate at which Treasury and mortgage bonds are removed from the central bank's balance sheet will be doubled by the Fed in September. Who will purchase the bonds? Dalio questioned, then pointed out that the real return on bonds has moved significantly low in the response to the question of whether cash is still trash, which is a catchphrase that Dalio has frequently used. He responded that keeping cash is still a trash investment because investment rates haven't increased enough to completely offset the effects of inflation. Cash's actual usefulness, however, is contingent upon how it compares to others. Dalio continued, "We're in this write-down of financial assets phase." When asked if he was still positive about China, Dalio said he was, but he added that, "Will there be a chance for long-term investors? It's a risky moment to be making investment in the second largest economy in the world." He declared asset prices are low. When adjusted for inflation, which has made pension funds globally and the Chinese central bank less inclined to purchase. The bond market was in a 40-year bull market. Price increases were self-reinforcing over 40 years, according to Dalio. Right now, the bond's real returns are negative, and you have them falling. When asked about the predictions of the direction of markets, Dalio responded with a witty jab. "He who lives by the crystal ball is destined to eat ground glass." Why does Ray Dalio emphasize on diversification and investment and also the importance of AI? The founder of Bridgewater Associates, Ray Dalio, gave investors throughout the world some crucial advice. Dalio didn't hold back when asked about OpenAI's well-known chatbot ChatGPT on this YouTube channel. His approach to profitable investing centers on the idea of diversification. Although there are others who contend that making large bets on particular stocks or industries is the path to enormous profits, Dalio strongly refutes that idea. He supports an investment approach that emphasizes diversification among several unrelated assets. Many believe that the greatest method to make a lot of money is to find the best single or few bets. That's incorrect. Rather, he places focus on making thoughtful investments across several asset classes, such as bonds, stocks, and real estate. Spreading investment around solely for show isn't the only way to achieve diversification. It's a method that dramatically reduces risk without sacrificing rewards, claims Dalio. An investor can dramatically reduce possible risk by 80% by investing in 10 or 15 good, uncorrelated investments. According to Dalio, risk reduction is really key to accumulating wealth. Dalio interaction with ChatGPT demonstrates how AI technology is developing, declaring that he thought artificial intelligence was only getting started. He made a suggestion that one day machines might be able to provide counsel better than human specialists. Comparing his extensive knowledge base to AI chatbots such as ChatGPT, Dalio speculated that one could be able to get an equally good answer from ChatGPT when it came to investing. We're living in a technological age, and Dalio's recent interactions have demonstrated that the investment industry is not exempt from its effects. His guiding principle is still diversification, but the wild card to watch out for may be AI's potential. What's your take on Ray Dalio's view on the markets? Do you think there's going to be a recession in the near future? Let us know your thoughts and views in the comment section. For more interesting stories and updates, subscribe to our channel and don't forget to press the bell icon for notifications.